Okay, here's a little secret that a lot of insurance companies really don't love talking about. Agents actually earn way bigger commissions on whole life policies than they do on term life policies. And honestly, that right there is a huge part of why so many people walk out of an agent's office with completely the wrong coverage for their actual financial situation. So let's dive into this explainer. Over the next few minutes, we're going to walk through exactly how these policy types differ, what term and whole life actually mean under the hood, what they really cost in the real world, and most importantly, how to figure out which one fits your life and not just the agent's paycheck.
So, picture this. You decide it's time to be responsible, right? You go get a life insurance quote, and suddenly you're staring at two numbers that just do not seem to make any sense together. You're looking at the exact same death benefit, the same-ish coverage on paper, but one quote is $20 a month and the other is $200. Now, the crazy part is that a typical 30-year-old might see exactly this scenario: $20 for term, $200 for whole life. I mean, that is literally 10 times the price for what looks like the exact same thing. But there's a very real structural reason for that massive price gap. And once you understand how these two policy types differ and how they operate, making your choice gets a whole lot easier.
Let's start with the simpler of the two, term life insurance. It's honestly exactly what it sounds like. You are buying coverage for a specific term, or, a set window of time. You pick a time frame, maybe it's 10, 20, or 30 years, basically whatever fits your current stage in life, and for that specific stretch of time, you are covered. If something tragic happens to you during that window, your family gets the payout. But here's the kicker. If you make it to the end of the term, the policy just ends. There's no refund, there's absolutely no leftover value, and nothing carries forward.
I actually love to tell people to think about this like renting versus owning. You aren't building anything long-term here. You're just renting protection for the years you literally need it the absolute most. And this brilliantly illustrates the exact time frame term life is built for. Just think about it for a second. Do you have a brand new mortgage? Do you have young kids running around the house? Do you have a spouse who would seriously struggle to pay the bills without your income right now? That is the exact timeline where term life is designed to act as your financial safety net.
So, just to quickly sum up the term life side of things, your premiums, they are totally fixed for the entire length of your term, which makes budgeting incredibly predictable. And because it's a temporary safety net, it's significantly cheaper. We're talking often 5 to 15 times cheaper than whole life for the exact same death benefit. Now keep in mind, there is absolutely zero investment or savings component attached to it. It is pure insurance, period. And that makes it simply the best option for temporary financial needs, like making sure your mortgage gets paid off, replacing your income while your kids are young, or maybe covering some business loans.
Now, let's totally flip the script and look at whole life insurance, which works entirely differently. This policy covers you for as long as you're alive, period. As long as you keep paying those premiums, it never expires. But that's not all it does. The really crucial difference here is that part of your premium pays for that death benefit, but another part of it quietly builds up in something called a cash value account. And this account actually grows tax-deferred over time. Later down the road, you can literally borrow against that money.
On paper, that sounds amazing, right? Almost too good to be true. You get lifetime coverage that never goes away, plus a savings account built right in. But there is a very steep, very real cost to that convenience. You're often looking at paying $100 to $300 more a month than you would for a comparable term policy. A big chunk of that hefty premium is being siphoned off into that cash value portion. And the harsh reality that agents often gloss over is that this cash value grows painfully slow at first.
So, what are the real takeaways when it comes to whole life? Well, yes, it offers lifetime coverage that doesn't expire, and for sure it builds that cash value you can borrow against. But those monthly premiums are significantly higher. In fact, because of the fees and the way the whole policy is structured in those early years, it's actually not unusual to wait a decade, sometimes more, literally just to break even on that cash value account. It's a massive long-term commitment. That generally makes it best for folks with permanent dependents or high net worth tax strategies, which we'll touch on in just a second.
Let's put some actual concrete numbers on this so you can see what I mean. Let's meet Dave. Dave is 35, he's healthy, and he's shopping for $500,000 in coverage. For a 20-year term life policy, Dave is probably looking at paying somewhere around $25 to $35 a month. Let's call it $30. But for a whole life policy, giving him that exact same $500,000 death benefit, try $400, $450, sometimes even more. That creates a massive gap. Dave is looking at a $420 monthly difference. That translates to over $4,000 a year in extra premium payments.
And that $4,000 gap is exactly why you'll hear a lot of financial advisors recommend one specific strategy: buy term and invest the difference. The whole idea here is that you buy the much cheaper term policy and you take that extra $4,000 plus you saved every single year and you actively invest it yourself. You put it into a retirement account or maybe a broad index fund. Why? Because historically, that money tends to grow significantly faster in the open market than the cash value sitting inside a whole life policy. It's not a 100% absolute guarantee always, but it happens often enough that this strategy is seriously worth thinking about for most people.
Now, I want to be super clear here. I am not saying whole life is some kind of scam, because it absolutely isn't. It just gets unfairly trashed online sometimes by people who don't really understand its purpose. There are a handful of very specific situations where whole life genuinely earns its hefty price tag. For example, if you have a child with special needs who's going to require lifelong support, permanent coverage makes total sense. The same goes for complex estate planning to cover future taxes, or high earners who have literally maxed out their 401ks and IRAs and just desperately need another tax-deferred bucket to put their money in.
But let's bring this back to reality for the vast majority of us. If you're an average person in your 20s, 30s, or 40s, and you're just dealing with the standard stuff, paying down a mortgage, raising kids, trying to stash some money away for retirement, honestly, term life usually covers exactly what you actually need, and it does it for a mere fraction of the price of whole life. Most of us just don't have permanent liabilities. We have temporary ones that will eventually be paid off, or kids who will eventually grow up and move out.
So how do you actually decide between these policy types? Look, it doesn't have to be complicated. Let's run through a really quick decision framework. Just ask yourself a few honest questions. First up, do you actually need this coverage forever, or just until the kids are out of the house and the mortgage is completely gone? If you only need the protection for those temporary liabilities, then term is almost certainly your answer.
Question 2, and this is a massive one. Can you comfortably afford those hefty whole life premiums without completely messing up your ability to max out your retirement accounts? If buying whole life means you suddenly have to cut back on your 401k contributions or stop funding your IRA, man, that is a huge red flag. If you can't afford it without sacrificing your retirement savings, then term is for sure the better choice. It frees up the cash you are going to desperately want to put to work elsewhere.
And finally, question 3. And you really have to be brutally honest with yourself on this one. If you go the term route and save that $400 a month, are you actually going to invest that extra money? Or is it just going to magically disappear into everyday spending, extra takeout, and lifestyle creep? The term plus investing strategy is incredibly powerful, but it only wins out in the long run if you actually follow through and invest the savings. If you know you have the discipline, it's really hard to beat.
Which brings us to our final thought. I really hope this explainer made the fundamental differences between term and whole life a lot clearer for you today. If it did, please stick around and subscribe. We break down complex financial topics like this all the time, strictly focusing on what you actually need to know to make the right call. And if you want to dive even deeper, go check out this source guide linked in the description over at myinsurancepost.com. Take a hard, honest look at your own budget and your own liabilities. But before you sit down and talk to an agent, ask yourself one final question. Are you buying the safety net your family actually needs? Or are you just funding your broker's next vacation?